So each year there's this metric that compares the performance of the market to how all those highly paid stock picking fund managers did. So last year, 79% of them failed to beat the S&P. And over 10 years, 86 of them underperformed. Now, Frank, what's the lesson here? What should our expectation of returns be when we're retired?
Well, here's the thing. When you're looking at the stock market, if you look at the last 15 years or so from, after 2008, after that crash, and you go forward, it just looks like the stock market just keeps on, other than a couple of downward swings, it's been averaging double-digit type of returns, But if you look at beforehand, what happened to, the 10, 15 years beforehand, I'll tell you what, the market was pretty flat. It went up, it went down, but, there was a 13-year span where, if you took the S&P 500 number in 2000 and then in 2013, they were the same exact number. So like 13 years with hardly any growth at all, so what you really want to do is you want to understand the market and how it reacts. You do want to try to, if you want to take on all of the risk of the market, then you want to try and at least do exactly what the market's doing and have that type of return. But we found that that's not the best way to do that during retirement. I mean, in retirement, it's not necessarily a good thing to have the major market losses when the markets crash. We had a couple of clients come in and we looked at their portfolio. I mean, these folks were 61 and 59 years old. They wanted to retire when he turned 65. So, in another 4 years or so. So they asked us to take a look at their portfolio and see what we could find. Well, the first thing we did was we did a risk tolerance. We wanted to find out, what kind of risk do these folks want to take? And when we did that, they were very moderate. They were, on a scale of 1 to 10, they were at 5.1, And then we did their portfolio and we looked at their portfolio. The portfolio was at 7.2. So they were at a significantly higher risk than they wanted to be. So they asked us to fix it, So, first thing we did was we looked at their portfolio, which was consisted of a lot of those, what do they call those, Frankie?
Those target retirement funds.
The target retirement funds. And I know a lot of us, a lot of folks have those in their 401k plans, and they say, they look at their 401k plans, they look at all these mutual funds, and they look at this one here says, if I want to retire from this time to this time, well, I could just pick that. Oh yeah, that's good, I'll do that. So is that a good choice? I don't necessarily think it is, and I'll tell you why. The older you get with those, the more money they put into bonds, into those mutual funds. And the problem with doing that is when interest rates are rising, the value of bonds is going down. They're putting bonds in the portfolio for you to protect your money. But in essence, what they're doing is they're putting that money into something that is likely to bring your money down. So that's not very, very good. What we do instead of that is we utilize fixed indexed annuities. Fixed indexed annuities go up when the markets go up. They don't go as high as the markets when they go up, but they have no losses when the markets go down. So that is truly protecting your portfolio. And over time, these things have averaged 4 to 6% type of return. So these are basically a better place to put, in our estimation, a better place to put your safe money. Then we utilize, tactical management, which, is designed to help put your money into the market when the markets are prone to go up. But, also designed that when the markets are prone to go down, that the algorithms within this tactical management take the funds and convert them to cash, or they convert them into sectors of the markets that tend to do well when markets are going down. So utilizing this type of strategy enables folks to, we feel, average a better rate of return. So what we did was we looked at their portfolio and we said, okay, let's take your risk. And we were even able to get it lower. We were able to get it to a 4.1. Their average rate of return over the last 20 years in their portfolio was 6.17, and we did our recommended portfolio would be 7.85. So obviously it's a significant difference. Then we were looking at the cost. When you look at the cost of mutual funds versus ETFs, which is what we use them because they cost less. ETFs or mutual funds cost 2 to 8 times. The internal cost is 2 to 8 times of ETFs. So when you put all of this together, and then we said, okay, well, if they had about a $500,000 portfolio. And we said, if you had that $500,000 portfolio 20 years ago and you put it into the portfolio you're in now, it would have grown to 1.576 million. In the portfolio that we are recommending, it would have grown to 2.131 million. So, if you do things the way you should be doing them, de-risking the portfolio, using the right types of investments, not wasting money with high internal costs, all of these different things, for them, it meant over $500,000 difference. Now you think about that over the course of the lifetime. What are the extra things that you could do in your retirement, with an extra $500,000? I mean, couldn't you go on more vacations, do more things with the kids, the grandchildren? You want to do home improvements, all of these different types of things.